controls with SBA. Bogo's been trying to get us here for
A while.
a couple of months now, 3-4 months, right? And just whatever, something's come up in the last couple of months, but we wanted to talk to you about, it's been good, it's been delayed because it's given us time to digest what is not yet a new tax law. And in fact, you'll probably need another one of these again from somebody in about 2 months, because we might actually have tax law in 2 months. But what we want to talk about today is, just some general tax planning things and then where the tax law is going. So I've got some income tax thoughts on where that's going to go, and Rick is going to share some estate tax thoughts on where things are going. He's busy right now. What did I hear today? Busier in a group of ants on a Cheeto. So he's like all over this stuff trying to, because I think the estate tax is really big. The income tax is still big, but the estate tax is, I think, even bigger if some of these things pass. All right, so we'll get started on what we have right now. If you have questions along the way, obviously small group, just raise your hand. You guys probably don't raise hands anymore. Just, speak up and I'll try to answer your question right away. A small group, I find that works really well. And if you have something specific you want to talk to me about your situation out in front of the group, I'll stay after too if you want to talk. Okay. Well, I don't know how long you guys stay. Maybe I won't stay after the sales. This is a big party or not. All right, there's our mandatory pictures. All right, so a couple of things that I want to review with you. Make sure you're taking advantage of from a tax standpoint, qualified business income, cost segregations with depreciation, 1031, passive activity rules, IRA ownership. Okay. I'll go fast through these. I'm sure a lot of you have heard of these topics right here, but also I'll go fast through them and get to the other things. All right. Qualified business income deduction. For those of you that do report income on your tax returns, are you familiar with qualified business income deduction? Is your accountant taking advantage of it? Right. So that's a poll. You can answer that. Yay, nay. Yay. Okay. So you're all good with this. So what happens is, if you haven't heard of it or you're not sure if you're taking advantage of it, you want to look on your tax return. There's a specific line, qualified business income. You're looking for a number in there if you have income. Rental income is qualified business income. Okay. Brokerage income is qualified business income. So you want to make sure you're taking advantage of it. There's some limitations. Limitations are interesting because at first the limitation for our upper income people is going to be 50% of the W-2 wages paid by the business. A lot of real estate businesses have low wages, right? And so this kind of hurt real estate owners. And so at the last minute, they stuck in this real estate bill, this real estate provision, which was instead of having the cap be 50% of wages, you can also say the cap is 25% of wages and 2.5% of acquisition cost of property. So this is something that actually broadened the cap ability for real estate owners, and certainly a credit to your lobby always seems to get something into every new tax law that's beneficial for real estate. So whoever you're paying out in DC, they're doing their jobs for you. WRA.
National Association of
Realtors. Yeah, they're there. Yeah, and they're probably there right now for some other things we'll get to. There was some argument that trader business is your rental income enough to rise to the level of what they call trader business, so you get qualified business income. At this point, I think the only thing that's not is if you own a triple net lease. If you have a bunch of triple net leases, it might be a trader business. If you have just one triple net lease, probably the IRS would argue it's not, but grouped together, triple net leases might not get there. I'll talk to your tax accountant about that. We do some cases with guys that own these or like Dollar Generals or general stores that you can trade into. So they get to the end of their real estate career and they trade into these more income producing solid properties. You can say Dollar General, and those are solid. Those are typically double net leases. And then we group those together and say that that's qualified business income.
They're triple B plus rated is like a Walgreens. It's hard to believe what they are. So.
The Dollar Generals are? Okay. Yeah, that's pretty high rated, and that's going to command a certain price, isn't it? Cost segregation. So this is a big planning tool right here. Are you all familiar with cost segregation? Are you using it on properties that you own? Effectively what it is Anytime you buy a property, and let's just pick a property for $10 million, okay? That $10 million represents stored up deductions that you can take. You can either do a cost segregation study when you buy it, and grab some of those deductions right away, or you can do a cost segregation study sometime down the road and use those deductions at a future point. And so the planning on when you use these cost segregation studies is important, because you don't necessarily have to use them in the year of purchase. You can use them at some point in the future when you do have an income event. So what we want to do in planning with this is make sure you're taking them at the right time. You want to take a cost segregation study when you have income to offset it. Cost segregation study is basically taking your property, that 10 million that I said in the example, and breaking it down into things that you can write off right away. Ever since September of 2017, what you can write off right away is 5-year or 15-year property. You can write 100% of it off. So this is thanks to Trump, that in the new tax law that was signed, 100% bonus depreciation applies to used property purchased after September of 2017. So how might this apply? And we do this all the time, and it could be something as simple as a duplex. You buy a duplex for $100,000. The outside property might be your landscaping and a driveway and fence in place. And that might be worth $10,000 out of that $100,000. That's all short life property. You segregate that out, and then that's an immediate write-off in the year that you buy it. So those are the kind of things you're always looking for to do. If you're looking for tax deductions in a given year, you're looking for those properties placed in service, bought after September of 2017. And here's a way that you can grab some deductions for them. So don't ever let your tax accountant come back and say, oh, a bunch of taxes and there's nothing we can do without at least exploring, hey, have we looked at all our cost segregation studies? Bonus depreciation. This is what makes a cost segregation study work. This is the magic within the cost segregation study. It's 100% bonus depreciation on your used property as of 9/28/17. This was a huge tax law change and a huge benefit to real estate purchasers. Bonus depreciation used to be 50%, and it used to be just on new property. So if you went out and bought a used apartment building, the cost segregation study doesn't allow you to use bonus depreciation prior to 9/28/17. After 9/28/17, you can use bonus depreciation 100% on that property. So this was a key date, and it made real estate, which was already attractive as an investment, even more attractive. Auto depreciation. Hopefully you guys have been around, you're all doing this, right? I don't know one real estate professional that doesn't have an auto used exclusively in business. It's taken right off, right? Expensing options. These rules have changed for the benefit of real estate owners in the last several years. One of the rules is $2,500 rule. Anything under $2,500 can be expensed, no questions asked. All right, that's a big one. There's a small landlord rule, but the big one we use is $2,500. Anything under $2,500, washer, dryer, whatever you get is expensed as long as it's not part of a major reconstruction. Part of a major reconstruction, the rules are different, but it allows for a much quicker way to go through a client's trial balance and say, okay, what can we write off that you capitalize if we're looking for some deductions? Passive activity loss rules. For those of you this from their real estate professionals, you probably understand the passive activity rules. You've heard of these before, which is basically your rental losses can't offset your other active income. If all you do is rental, you probably are a real estate professional and you're not subject to these passive rules. But if you do things other than operating a real estate trade or business, you might be subject to these passive rules. And in that case, what we do is try to work with the spouse, if there's a non-working spouse, and get that non-working spouse to be a real estate professional if one of the spouses has a job other than in real estate. So you have a job other than in real estate, you have a non-working spouse that becomes your real estate professional, and now you can take all these losses and take advantage of the real estate losses that get spun out of, say, a cost segregation study and use them against your other income. One of the last things to talk about just in planning is your IRA ownership, whether it be an IRA, Roth IRA, or you set up If you set up a management company, pay yourself a wage, you get money and you're so okay. What you're trying to do is build up money in a tax exempt, at least currently tax exempt fund, and then use that to fund real estate purchases, use that to fund essentially buys or sells. So it can fund hard money lending, it can fund deals of other people. And what you're trying to do then is stock away and build up your own IRA, Roth IRA fund. Now, there is some abuse of these going on, so you're going to hear some more about that. Some of the current tax proposals have, hey, if you have too much money in here, we're going to force you to take it out. That too much money number is still really high. But some of these large IRAs and Roth IRAs have gotten some bad press because effectively, by self-managing this in real estate, you can really create a lot of wealth in these. And if it's a Roth IRA, that wealth is never going to be taxed. Were you going to say something?
I was gonna say that I heard somebody on CNBC that the Roth IRA went up huge. The amount, is that true in 2021?
When you say went up huge,
The amount you can put it, that you can put into a Roth.
no, that has not gone up huge. The amount of money within Roth IRAs has gone up huge. So if you add up all the
Yeah,
Roth
okay.
IRA
Yeah, no.
accounts, that's gone up huge. But what you can put in a Roth IRA, and there's different ways to get there, is you get $7,000 in a year, or you put some in a 401k that has a Roth IRA option. You can put 19,000 in, and then you roll that into your Roth IRA. So there's different ways to get it, but it's not easy to get pre-tax money or get after-tax money in there. Now you can roll over an IRA that's regular IRA and put it in Roth, but you pay tax along the way. Okay. There are strategies to roll over your regular IRAs and put it in a Roth IRA and take a discounted amount on the amount that's in that regular IRA when you roll it into a Roth. Okay, so picture you have $1 million in a regular IRA. You want to move that into a Roth. You put that $1 million in a vehicle that gets a valuation discount, like some kind of partnership interest, and then it's only worth $500,000 according to the valuation report. Then you roll it into the Roth IRA and you pay tax on $500,000 instead of $1 million. And at some point, that $500,000 regrows itself back up into a high value. So there's those kind of plans out there. Those are probably aggressive, but I think they're getting more use until at some point they don't, because they get caught. Okay, so there's sneaky ways to get it in there, but then the other ways to get money in your Roth IRA is you use it. Essentially, you might lend it to Pogo and Pogo might lend his to you. Okay, now you don't want necessarily a direct relationship there, but you see that kind of thing, and all of a sudden you're paying him a bunch of interest into his Roth, and he's paying you a bunch of interest into your Roth. And what it might look like is you're just stuffing money in your Roth IRA on a tax deductible basis.
Let's do that. I'm thinking that sounds
Great idea. I'm not telling you to do that. I'm telling you there's ideas that might end up looking like that. Okay. In general, and you can also have your Roth or your regular IRA own real estate. Not necessarily a big fan of that, owning real estate directly in these entities. A couple reasons. One is, you can't guarantee debt of your IRA or Roth IRA. So you have an acquisition or a debt acquisition issue there. The other is if it starts running out of money, it's hard to get money in there to fund it. So there's reasons why you don't necessarily want to have real estate in your IRA, but investments in real estate, like investments in people's properties that are flipping or loaning, that's actually probably a pretty good investment for an IRA. You were talking about, someone was talking about mobile home parks before. I know someone who takes their IRA and they just lend it to mobile home parks and the people that buy those mobile homes. Turns out the people that buy mobile homes are acceptable to a very high interest rate. So that's what he does. That's what all that.
It turns out,
All right, so coming up. Skip one slide. Okay. So changes in the tax law. There's a couple different proposals out there. There's what Biden wants to do, which is what he's been saying all along. He doesn't have a concrete written plan now, but he has his ideas. I'll do this, I'll do that. And so some big tax increases there. And He's got a lot of support from people in the party, like Bernie Sanders and AOC. I forget her full name. So he's got a lot of support from people in his party there, but I would say a very left-leaning on the political scale. And then there's people in the party who are not very left-leaning, and the big one that's making a name for himself now is Joe Manchin from West Virginia, who's trying to put the brakes on this. Right? So if you recall what happened on election night, in the morning you wake up, maybe a couple mornings later when they figured it all out, Democrats had 50 Senate seats, and they have just enough in the House. I think they're margin of 6 or 7 House seats. So they don't, to pass tax law, to pass financial law, they actually don't need a lot of Republican votes. They don't need any, right? So they don't have to make compromises anywhere except within the, and that's what you're seeing right now. They're fighting, within their own party. Joe Manchin, mostly from West Virginia, who's the headliner, but there's also a senator from Arizona on this. And then on the left side is Bernie Sanders, and in the House is AOC, and they're kind of trying to push these bigger bills. The two bills out there right now, there's a transportation bill for 1.2 trillion spend out there that's funded mostly with borrowing, and one little tax increase, which is the removal of the ERC, employee retention credit, for the fourth quarter. Otherwise, it's funded with borrowing. That one's got a lot of support, and it's even got Republican support. That would pass, except that people in there are some in the Democratic Party that don't want to pass it unless they also pass this much bigger bill. This much bigger bill is a $3.5 trillion bill. That's Biden's baby and proposals that is supported by AOC and Bernie Sanders. And then there's a written bill. There's actually a written bill by the Democratic House, and it is for something around 2.9 trillion. And so that 2.9 trillion has some tax increases in it, but not as many and not as much estate tax increases. So we'll go through what's in there right now. One is corporate tax rates. They're almost certainly going up right now. The top corporate tax rate is 21%. That could go to 25, or it could go to 26.5, depending on where they're going to go. The big bill has a 28% corporate tax rate. Individual income tax rates are going up. Right now, the top tax rate is 37%. Under these bills, it would go up to 39.6%. 39.6% is actually goes all the way back to Clinton when he raised tax rates in 1993. Went to 39.6%, then they came down for a while. Then they went back to 39.6 under Obama, and Trump cut it back to 37% as the top. So again, 39.6% seems to be their magic rate. That is again likely to happen. It's something that Manchin is on board with. This 20% qualified business income exclusion, there's a proposal to reduce that for those that have income over $400,000. The current written Democratic plan doesn't have that reduction in it, but Biden would like his ultimate plan had seen that done. This could affect people in this room, the elimination of the active trader business exclusion for the net investment income tax. So right now, if you're a real estate professional, you don't pay that 3.8% net investment income tax on your real estate income. These proposals include saying, yes, you do have to now pay that 3.8% net investment income tax on your real estate income. And that would be for real estate income over a certain dollar amount, like 250,000. Capital gains rate, again, this is a big one. Not only what the rate is going to be, but when the effective date is going to be. So the Biden plan had the effective date in April of 2021. So going all the way back to April. And it had the rate as no rate. It's the same as your ordinary income rate. So if the ordinary income rates go up to 39.6% and you sold it with a big capital gain, then that's what your capital gain rate is, 39.6%. What is it right now? It's 20%. So that's a pretty big swing in the capital gain rate. The current plan, though, that the Democrats wrote is actually 25%. So the capital gains rates, instead of being 20, would be 25% under the current Democratic plan as written. There's also a loss limitation that would affect those that have losses from businesses to offset other income. That loss limitation could be 500,000. 1031, that's your exchange provision. Biden wants to eliminate 1031s for those trades that are end up with a gain over $1 million. That's not in the current Democratic 2.9 trillion tax bill. So I think 1031 is probably safe. And again, that is probably thanks to your NARA or who's out there in Washington 1031 was on the table, it's been on the table before, but that proposal keeps getting killed, and it's not in the Democratic plan.
What would that do to the economy? Removing 1031.
So what I think it would do, this is just my personal opinion, is it slows down the movement of capital of those that want to get out of certain projects. Okay, so I think you're gonna stagnate a little bit on the prices, and I think people will hold until someone comes back in and tries to put 1031 in. Just because they take it out now, I don't think that's gonna end up being permanent, even if they do take it out now. Because there could be a flip in administration, and I think that the real estate lobby will be right back in there the next time they have a tax proposal and try to get the 1031 back in. And I think that there are advisors telling Biden that as well, and whether it's selfishly or, there's really fact behind it. That 1031 is going to freeze up your large transactions.
Yeah, I
So
was
you're
thinking
gonna
like
start
that,
with capital that-
office towers and stuff like
Yeah,
that.
you're gonna be stuck with people who, don't want to move that capital around, keep it invested in that, and that could stagnate those high value properties. So this chart right here, and by the way, we'll send all these slides out, maybe we'll send them down to where we say you can distribute them. It's just really what's going on as far as current proposals. You got this is what current looks like. Okay, then you got, here's the House bill. So the House does have a bill, right, that has 39.6% top rate, 25% capital gains, which, by the way, they moved the date to September 13th. There's an additional surtax in the House bill for income over 5 million that doesn't currently exist. And so you can kind of read down the line, that's what the House provisions are. What the House provisions ultimately do, they're trying to raise 2.9 trillion so that it can offset this 2.9 trillion of spending that they have planned in this bill. And that 2.9 trillion spending is for green, it's for colleges, it's for all sorts of things that they're going to spend it on. And then the president has his proposals, but there's no concrete plan written yet. This actually is a bill. It's written. The president's proposals are simply ideas on a sheet of paper. It's not written yet, where he says ordinary income 39.6, capital gains, there's the big one, 39.6 as of April 28th. And the corporate income tax, he has at 28% versus 26.5 currently now. It's at 21. There's also this SALT cap, which you hear a lot about, especially from the bigger states, California, New York. Your real estate taxes, not on your rental properties, but just on personal, and your income taxes limited to $10,000 deduction. There's a whole bunch of workarounds going on right now for that. And so if you're paying state income tax of more than $10,000, if you're paying quite a bit more, you want to talk to your tax advisor about how to get around this SALT cap, because Wisconsin has an election for flow-through entities to get around this SALT cap. SALT being state and local tax.
Could you go a little deeper in that, Wisconsin?
Okay, so give me an example. Let's say I have an apartment building I own by myself that makes $1 million a year. Okay, that $1 million, I'm going to pay $70,000 of Wisconsin taxes on it, right? I'm going to get only a deduction for $10,000 on my Wisconsin return, or on my federal return. So if I itemize, right? So I'm not really getting a benefit of paying that $70,000 of Wisconsin tax, right? But now let's say I take that same building, I put it in a partnership with my wife, file a partnership return. Okay, all the other economics are exactly the same. That partnership can elect to pay that $70,000 on my behalf. And now I get a full $70,000 deduction at that partnership level. So when my income flows through to my personal return, instead of paying income tax on $1 million, I'm paying income tax on $930,000. I've effectively lowered my taxable income by $70,000. If my tax rate is 30%, then 70,000 times 30% is $21,000. I've effectively saved $21,000 by just filing a partnership tax return and making that.
Sweet.
So, yeah, and that's, so any time you have sole proprietor, we'll call it a Schedule E property, that's typically what people file, that makes a lot of money, you want to get a state tax benefit from it, you want to make that election. Now, if you're not paying taxes because you make $1 million on one property, you lose $1 million on another, okay, then you're not paying taxes and you don't care. But it's only for people that care because they've got enough income that they're paying taxes. We've got some of those folks because they're not buying any new properties. Their properties are almost all paid down. They're depreciated down. There's not much left to do for them. But they want to trade out at some point, but they're paying taxes right now because they've lost all their deductions. This is the important one, 1031. It's allowed on the House plan, allowed currently, of course. And the presidential plan is basically to repeal it or limit it to those with gains under 400 or under. So this one right here, this 1031, I'd say of all the things that are out there, this is just likely to continue to be allowed, especially since it's in the House plan already. What I look at it is the House currently written plan is essentially the top that they think they can get an agreement on, the top spend 2.9 trillion and the most tax increases they think they can get away with, which means that the negotiations, they effectively lowered their starting point of negotiations from Biden's plan down to this right here. And I think it's still going to be squished even further, which means that I think once something like 1031 is back in the plan, I don't see how it's renegotiated out of the plan. That's my state tax. I'm going to turn it over to Rick and talk a little bit about a state tax because there's some important things in that area as well.
All right, interrupt you for 1 second.
Yeah.
These two are gonna leave because they're going to the game, and I neglected to introduce Eric Higgins, who's my guest today, and he is my property management since the first of the year. Enigma Properties now manages Eastman for me also, and Eric is also a client of Eric Gross. So it's
Small world.
pretty incestuous here. So
Since we have to leave early, the second half, we're gonna have to pay for instead of getting up here.
So
There's
Eric,
always
maybe
a
What
have
game
to
are you
say-
going to? What's the game? It's just open the other.
The ring night.
Ring ceremonies today.
While we're on a break, I'm gonna go.
That's awesome.
Peace out right here.
Who's leaving early? Yeah, just if you want to talk about estate stuff.
We'll take it along.
Oh, yeah.
It kind of looked like a hot schedule.
Anyone else need a drink for this next?
Cocktail time.
Wait for you guys.
Appreciate it.
Go Bucks.
Who do they play tonight?
I just have to enter the next screen here.
Yeah.
You did an awesome job talking about some income tax potential changes and the history behind that. One of the things that I was asked to talk about again is where I come from, and just diving a little bit deeper. We don't need to go here because they were brushed over it, but yes, in April, President Biden took the TV stage and said, "Here's my Build Back America plan. This is all that stuff I want. It costs $3.5 trillion. How are we going to pay for it?" Nobody knows. He had all these ideas written, on the back of a piece of an envelope. The Senate finally did pass what they're referred to as the Build Back America Act for $2.5 trillion. The House Ways and Means actually in September approved its section along with the tax increases that may ultimately form what we would call the budget bill. The government's fiscal year starts September 1st. They don't have a budget right now. The debt ceiling was delayed because we would vote that by now. We would have defaulted on everything to December. So between now and probably when that pushback is in December, there's going to be a lot of negotiations. We'll have changes. We don't know exactly what they'll be. We think we know what the bigger ones are going to be. Not even sure what the effective dates are because is it April 28th? Is it September 13th? Is it on the estate tax side of things? The lowering of the lifetime exemption is to take place on January 1 of 22. Everything else, all the other changes I'll talk about are scheduled to take place on the date of enactment of the final passage of the bill. And when could that be? Anytime. So I've been telling people since January to do stuff sooner than later because ultimately there aren't enough appraisers or trust in estate people to make changes to your estate plans. Just in a very broad way, one of the biggest changes that I think are going to be coming out of that budget bill, as I said, the estate tax exemption, which is now 11.7 million per person. You can either give away during life or die at death and give at death 11.7 without worrying about the gift or estate tax. If you're married, you can double that to 23.4. That was raised in 2017 as well, from what it was 5+ million. There's a starting date of 5 plus the inflationary figures. All the individual tax provisions that were put in place in 17 We're scheduled to sunset anyway at the end of 25, beginning of 26. State taxes are no different. That 11.7 number was scheduled to go back to 5 plus inflation, which I calculated to be 6.03, effective 1/1/22 now.
Is that double with the spouse?
This would then be doubled with the spouse to be 12.6. But this was supposed to sunset in 26, 1/1/26. The budget bill will have it come early because that's one way to help pay for this spending. A lot of changes to put our grantor trust. When I talk about grantor trust, I'm not talking about your revocable trust, which happens to be a grantor trust. These are non-revocable trusts that can be grantor trusts. You might hear acronyms like SLATs, Spousal Lifetime Access Trust, GRATs, which are Grantor Renamed Annuity Trust, ILITs, Irrevocable Life Insurance Trust, can or cannot be most are a grantor type trust. Some of these strategies that we've been using for many years might no longer be strategies. And why is that? Because right now you can sell assets to a grantor trust. We often call those intentionally defective grantor trusts. They're real trusts, but from an income tax standpoint, they're disregarded. From an estate tax standpoint, they live and stand, they breathe, they're like another person. You can sell stuff to that trust. If you have a kid, you want to take over the business, you want to sell the business, you might sell the business through that trust. You take a big discount, and guess what? That gain or loss that you might have on that sale doesn't happen because the grantor trust for income tax purposes disregarded, the sale doesn't even count. The interest that the child may pay back over time to you also not impactful to you. The problem is in the budget bill, they want to make that transaction tax. So if you did sell that part of your business or all of the business to a potentially defective grantor trust for the benefit of your child, now you've got a gain to recognize.
So they're really going after the irrevocable trusts?
All of these provisions related to grantor type trusts relate to the irrevocable type.
So even the SLATs?
SLATs, GRATs, SPRITs.
And when they say
SLATs.
newly created, when do they think that's going to be?
So all trusts that are in place now, all grantor type irrevocable trusts are in place will be grandfathered. What does that mean? That means, okay, you're good. All the transactions you've done so far are happy transactions. But if you wanted to do more in the future, so let's say I have a SLAT now, but I want to put more in next year. If I do it after the effective date, that contribution will poison that trust. Not all of the trust, but a part of it. A portion. So if I put in a 10 million last year, and I would do 2 more million this year to use up the rest of my lifetime exemptions. That's what Eric and I are telling you to do. But you wait too long. You wait till, let's say, December 29th, when the effective date, as I say, could be December 26th. Then 2 million now could be treated as a defective contribution. And that contribution will make part of that trust either a gift or future distributions from that trust could be gifts. Or if you know about a SLAT, and it's a grantor type trust SLAT, you can turn off the grantor feature, usually by disavowing substitution of asset provisions or the right of loaning provisions at lower interest rates. If you turn those provisions off and turn off the grantor feature, as we would say, turn off the spigot, that could make all of that trust, or at least a portion related to the new contribution, a gift. Right? We don't want those things. So we've been telling people since January to start real estate planning. And now we're telling them even more, like, if at least you're gonna do something, get some trust in place, even on an island. You know, something as simple as holding a life insurance policy, right? Most of them hold life insurance policies and the premiums are paid every year. And you're using the annual amount, $15,000 a year, 30 if you've got a spouse, to fund gift-free, gift tax-free, that annual premium. So now we go into next year. If this law passes, that contribution, that premium amount, could muddy the waters of that trust. So we're telling people to pre-fund their islands. If you've got an island in place right now, and you know that you're going to pay $100,000 in premiums over the next so many years, put $100,000 in today, so the contribution is in pre-enactment. So otherwise, grantor trusts, a good part of them, some of the benefits may not take place anymore. and we may not be able to use them. So we're trying to get a lot of grantor trusts in place. Now slats we're setting up. I'm hesitant to set up grants. We talk about grants because there's some other things that could cause a problem there. If you look at the last point here, I'll see it. When you set up a grant, you put in really a tax-free strategy. You put in an asset into a trust, and you hope that you're getting paid back an annuity over time, essentially equal to what the value is. Now, if we were able to take a discount, wink, wink, nod, nod, you're getting not necessarily paid back the whole amount, but according to what the valuation was, you're getting paid back the whole amount. Why do you care? Well, because the value of that asset might pop in 5 years, and it might be worth double the amount. Well, at least you're keeping that appreciation out of your estate. So that's why it's called a free strategy. Now, these assets, they're not all liquid. Oftentimes, we're paying the grantor back by the annuity payment with a piece of that asset. So this new law would change that ability to pay back with an appreciated asset and make that a taxable transaction. So grants may go by the wayside. The whole ability to discount could be eliminated to some extent. What do I mean by that? What they're attacking, initially in January, they're attacking a lot of things. They were attacking family-owned businesses. They were attacking passive activities. That could real estate could be considered a passive activity. If you are taking valuation discount for those types of estate planning strategies, the old January proposed legislation, Biden's proposed legislation would hit some of that. The current legislation in the House, the tax bill, will hit much less. What it really is going to attack is what, if you've heard of family-owned partnerships, people taking marketable securities, say you've had a liquidity event, you take $10 million of marketable security stocks and bonds, they put it in a partnership. This is the way they start bringing the kids into the portfolio business. They give them a piece. The senior generation maintains a controlling the voting control. They got all the vote. Maybe they have like a small portion, but still all the vote. The IRS would, or excuse me, Congress would tell you, we'll have to take a look at this in two pieces. If you've got an entity and it's got marketable securities, you get no discount. If it's got an operating component to the business, you'll still be allowed the discount. It could be a family business, it could be a real estate business. The problem is they're going to want to attack the marketable security part. Why were we even taking discounts on marketable securities in the past? Because they're liquid, you can sell them and hand them up. What we were doing is in the partnership document is restricting liquidity. So if you're a partner, if you trust for a child as a partner, maybe they don't get distributions. Maybe when there's a sale, they don't get a liquidity preference, or we're putting all kinds of lockdown provisions in there to make it unattractive that if you were on the street and trying to sell that piece of the partnership, that someone would never pay 100%. And that's how you get the discount. Well, we all know that in the end, mom and dad are going to pass at some point, and the whole thing's going to go to them. They'll end up getting all of it. But in the meantime, the ability to do this in the partnership strategy is very attractive, especially for people that all they had was liquidity now. Yet Congress sees that right through that, and they want to come back and say that's not going to be discounted any further. So before enactment, and it says here before 22, but as I said, this is enacted and they keep the enactment dates. They don't have to keep the enactment dates. That September 13th date could be moved too. We don't know, but that's what's in there now that Eric talked about. But like
It's
I
all
said,
negotiated, so the final thing that they'll say it's effective on a certain date.
everything is negotiated until it's finally passed and signed. Because even the president could still veto something, go back for further process. And as Eric wisely pointed out, it's not necessarily the Republicans against the Democrats. It's the Democrats within their own party understanding that they can't live on this type of spending bill, right? West Virginia, Arizona, some of these states had some at some point Republican homes type people, but whatever they want to do, the point is they're saying if it's 3.5, it's 2.9. Joe Manchin is saying he wants it 1.9 and 2.1. Well, if they bring the spending down, they can take out some of the tax changes that we're saying that are in there now too. One of the biggest things that isn't even a tax increase is putting spending a lot of money on the IRS with the idea that whatever they spend, they're looking at targeting, bringing back in house 900 billion more. So if the bills, they're gonna, less than 1% of the people are audited. So they would expect to audit like 2%. And they're gonna go after high net worth folks, and they're gonna try and come after the bigger strategies that people are utilizing that maybe they can hone in on. And that's how they think they're gonna get to the 900 billion number. That isn't even a tax increase, it's just through the IRS being more aggressive.
By the way, you guys in this room are the demographic.
Yeah.
Okay.
And I don't know if you heard this.
I think that was my next question.
Wonderful.
Am I included?
Get your association on this one. Pelosi's party wants to have your banks, give them information if you spend more than $1,000 or is it $10,000 or $10,000? 600. Well, I think it's changing, but it's going up a little bit. But that said, I mean, everybody spends money. Your payroll checks come in. If you're, that would be a trigger. All your transactions would go right to the IRS. So I just,
PayPal
and all bank accounts, not just Venmo. Bitcoin, of course, they want to get after, but it would apply to all financial institutions. So get the association on that.
So are real estate investors at a lot of risk, for auditing? Are they gonna pick apart things that normally they wouldn't?
I think they're gonna somehow have to come up with a program to decide where is the most bang for their buck, because this really is an investment by the government to generate more dollars. And so they're gonna try to come up with a program for that, and it's probably going to be, I would say, small business owners that are wealthy, which includes real estate, which includes owning your own company, manufacturing. Small business owners, I would say, have demographically they have the most ability to be able to move things around. Larger businesses that have multiple partners that are outside the family have watchdogs over each other. Okay, if you own your own apartment building and you're going to write a car off, well, who's going to stop you? I'm going to buy a $90,000 SUV Mercedes. Okay, you don't have any partners to report to say that's a good business expense or not, so you can do that all on your own. So I would say it's going to be the wealthy, family-owned, controlled businesses that if I were running the IRS and I wanted to raise some revenue, that's one place I'd start looking, is I'd really hone in on it. Now,
Like who's more at risk? Like Penzi, the spice company, like Joe
It's a
Schmo.
family business.
yeah,
The IRS needs to shore up their personnel. They don't have enough people. They don't have good computer systems to audit. So, I mean, originally Biden thought that through this aggressive approach from the IRS, they'd get like 1.8 trillion. Well, the government accounting office looked at it and said, no way. Because first of all, SBA can't hire enough people. You think the IRS is going to hire for half of what we pay? I'm just kidding.
Well, I saw the average age of an IRS agent was like 50, 55 or
So
something.
there's not enough of them, and they're not the smartest tool in the shed. So, I mean, I remember auditors coming in to audit past. I started my career in '86 out of law school. When the passive activity rule came into place, I haven't met an auditor yet that understands the whole working relationship from active to passive to a real estate professional and how you can work that with husband and wife hours together. And I've met some good ones, but no one's really hit it on the head. So, they've got to train them all. None of this is going to happen. So I don't know how they calculate their numbers. It's all magic.
I figured,
I was just so looking, it's been, it's on his third audit now, the last 5 years.
so once they find you, if they get some money from you, they can come back. And I work with a guy that is a real estate guy. He's on like his third audit too, and he has an airplane, right? Okay, to use that airplane for business. So they just keep circling back.
In his airplane.
Well, you write those $30,000 flights off. If you write a $30,000 flight off, it's hard to explain that.
but a lot of
In
those
the
guys
general
hire,
Should a person be looking at liquidating assets from the state that are meant to be liquidated before the end of the year? Is there, I know it's not an
Right,
easy
so
question.
liquidation isn't the exact word I would choose,
Yeah.
but
So-
let's say you're a state, I would tell you right now that if you're married, and you and your spouse have over $10 million, And it's not just your hard assets and your cash, that's liabilities. I told some folks here over the last several months, if you don't have an irrevocable life insurance trust, all the life insurance you own, and it could be lots of money because you maybe have debt, you're trying to provide for that. Those life insurance death benefits are added to your net worth. So if you've got a net worth of 10, you've got 5 million of life insurance, all of a sudden you've got a taxable estate. No one should ever pay tax on life insurance. So first thing is, if you've got life insurance not in a revocable life insurance trust, get one of those set up today. Pre-fund it with premiums that you're going to be paying into the future. And then not liquidate, but if you have the ability to live the way you want for as long as you want, keep enough for yourself. If you have heirs, start handing off some of those assets now. The problem is, if you want to really make use of the 11.7 number that exists today before it drops to 6 next year, there's some math that people don't understand. So we had this number in 2000, before 2017 law change, 5.85. And then with the change in 17, it's up to 11.7. If you only give $5 or $6 million, I say only, if you only give $5 or $6 million away today, and the law changes 1/1 of 22 back to 6, you won't have accomplished anything because you won't have got benefit for this additional amount. If I want to have the benefit for 11.7 before it drops, I need to give 11.7. I need to give at least about 5.8 or 6.03 to get into the bonus period. Because if I don't get into the bonus number, I'm doing nothing but giving away the 6 that's going to be the number in January. So that's a little bit of math that people don't get. It has to be a significant amount, right? And so then people say, why would I want to do that? I don't know if I need that much. So that's where a SLAC comes in, spouse lifetime access trust if you're married. You've got the ability for the spouse to maintain the income if it's needed, to draw it out for health, education, maintenance, and support, as long as you're married, of course. But it's the ability to freeze those assets and have the flexibility to grab if you need. But we would say don't if you don't need it, because every time you grab money out of it, it's like bringing it back into it.
What about a single individual and their daughter?
Any type of
Versus the spousal things, if the daughter inherits
Yeah.
an estate and that could be sold before December 31st, is time of the essence.
when you don't even have to sell it, we can still get use of all of our minority discounting from your business if we can get an appraisal done in place. So let's say you have a business or a building, a series of buildings, let's say that pocket of assets is worth $15 million. And you need some of the income stream, and you know that maybe you have some other assets on the side as well, but you go to a financial advisor, you work with SBA, and you figure out, well, I need this, but I can get rid of some of this, and that's going to help you from that lifetime exemption. It's going to future appreciation out of my estate. I can use discounting before they take potentially some of it away. So now we carve off a piece and you give some of it to an irrevocable trust for your child. Doesn't necessarily, they don't get access to all of it now. Maybe they get some stipend here and there. We can put all kinds of provisions in that you can think of. If you can verbalize them, we can work with an attorney to draft them.
But the sale would be.
You can sell it
You're
later.
not selling,
You can sell it later. You don't have to sell it. You just have to.
Okay.
you're giving a trust.
Okay, and how would the person who needs the cash, the younger person, the daughter, get the cash?
So it depends on what the assets are. If they're income producing, potentially some of the,
Residences.
okay, so like personal residences. So QPRs, qualified personal residence trusts, are another type of irrevocable trusts that you can set up two. You have one that's your personal and one that's your secondary residence. If you want those assets to go to your child. And the way you calculate what you're giving away though, you figure out what the value is, you retain an interest, so you're going to still live there, and you're going to say you live there for a term of years or the rest of your life. The longer you live there, the more you're retaining. You take what you're retaining away from the value, and that's what the gift is. Those types of grantor type trusts will also go away before the end. So I've worked with some folks just recently who have some large value residences in DC that are thinking about doing that. I
So
suspect they will.
QPRS
Qualified personal residence trust. Cupert.
Cooper, you can do a Cooper and then put the whole thing in there and they rent.
You pay rent, correct, which is another way to get assets out of your estate.
Pay rent to yourself.
After the Cupert term ends, right?
They actually get to the trust, to the trustee.
Well, after the Cupert term ends, technically the trust terminates. Right? Now the child owns the home you live in. Hopefully they won't kick you out. But usually at the same time, you set up a Cupert, you set up a lease, so the lease is already in place.
This is for somebody who already passed away and is waiting for the asset to fall in their lap without any strings attached.
You can't do a Cupert for someone who's passed, because by definition, they don't have a personal residence.
Oh, okay.
They're not living.
So if I were to purchase the asset, how would that change things? I would have to live in that personal residence.
Would you, so do you have a, assuming you have a personal residence, or you have a secondary residence?
This could be a
It could be
secondary.
your secondary. You can do
Tertiary, is it just two?
Yeah. Right.
Personal and
Secondary.
alternate or secondary. Thank you.
So everybody knows, should know what the discounting process is. And I've already explained what is under attack is really not anymore the business valuation itself. It's the rest of those marketable securities that people have been doing for probably a couple of decades, getting the discount mainly for the partnership drafting itself, not so much for the underlying assets. But we're doing the same thing with businesses. I mean, truthfully, business is worth what someone's going to pay for it. The ability to take a discount really is wrapped around the limitation or the liquidity of the entity itself, or the minority piece that you're giving away, right? So minority discount as well as market. This is just an example of someone had a manufacturing business, but they also had $3 million of publicly traded stock. If you're going to give a third away, you'd have to say a third of the publicly traded stock doesn't get a discount, it would be $1 million, and then whatever the value of the operating entity would still be able to take the discount on that piece. We've already talked about the grantor benefits they want to take with the grantor trust. One of the things that we'll do with grantor trusts when we set them up early in someone's life, or at least when I say early, even when people do it in their 60s or 70s, the mortality these days, people are living for many, many years. The assets that go into these grantor trusts, while they appreciate, the basis is low. It's what you put into it. So we'll do that before someone passes. Sometimes we call it deathbed planning, but sometimes we'll do it in advance of that, where now they've got outside of that trust some higher basis assets. What made it a grantor trust to begin with was the ability for you to take an asset and swap it out. So we can take a higher basis asset, put it in, take the low basis asset out, not a taxable transaction, but the beneficiary of that trust at some point now is going to thank you, because when that trust sells that asset, there'll be no gain or loss to that. That's under attack. Talked about that, talked about the effective date. Urging you to act sooner than later, because again, the ability and what's being attacked as part of these trusts takes some of the benefits away. Pre-fund your ILETs. What I really want to tell you here is, look, I don't know, none of you are actually in my clients right now, but the way you work with someone is, let's understand what the legislation is. Let's understand where you are today. What is your projected estate? Do you have an estate problem, estate tax problem? Do you have some assets that we could take valuation discounts on now that maybe we couldn't later, or maybe might be modified later? Should we talk about accelerating, putting in place some of these trusts before we can't use them anymore? Should we talk about doing some sales so people can sell assets? You don't have to give stuff away, so you can get an income stream back. You can also use discounting on that. Should we maybe look at your ILET that you have now and actually just turn off the grantor feature, or what's called decanting, set up a new trust, take the policy from the old trust, put it in the new trust, it's not a grantor trust, then you can continue to fund it on an annual basis going forward. We're looking at those things. I don't know, what's my time situation? I mean, I could go on for hours. Really, this talks about the intricacies of a SLAT, spousal lifetime access trust. Essentially, you're taking, or your spouse, and you can do one for the other. You can do two SLATs if you're married. One takes assets, puts it in trust for another. The benefit is that those assets are sitting there. They don't go to your kids right away. And if the world goes to hell in a handbasket, you can still have access to those assets if you need it. Ultimately, they do go to your children.
Stepped up basis is something.
Pardon me?
Stepped up basis, what you.
In a SLAT?
No.
What you're giving is,
Yeah, regular step.
Your
Is
basis.
there gonna be a change?
Right.
oh,
I
what,
think that's what everybody wants.
two things are not proposed right now. They're not gonna change the rate. They talked about changing to 45%. The thing they talked about is either taking away the stepped up basis or having some type of taxable event at that to bring the basis up to either one of those two. None of those are in any of the bills out there now. It's still in Biden's head, but so we want to keep it out of his head, but we don't think that those are plausible. Okay. It's not needed right now to fund the 3.5 or the $2.9 trillion bill. So if they don't need it for that, why would it come back in? All I can tell you now as we sit here on October 19th is if you haven't done any planning, get to it. If you're not worried about an estate tax, because maybe you think your net worth or your estate is lower than it is required to be to pay a tax. Hopefully, you all still look like you're able-bodied people and are working and growing your asset base. Now, the lifetime exemption only goes up by inflation every year. So if your IRR is 10% and inflation is going 1, 2, or 3%, at some point, usually I see people later on in life that maybe could have done some planning now that didn't, and they wish they did because now they're over the number because they work so hard. That's it.
One of the scary things, planning, you try to put something into a SLAT, you're giving up the step up in basis that's available if you die with the property because it's going into today's basis. If they change the rules, you did the right thing. If they don't change the rules, you wish you wouldn't have done it. That is that what's going to happen over the next 90 days.
I mean, not necessarily so. So while you get a step up in basis, you also pay 40% estate tax if you have appreciation that is going to be taxed. So let's say you got a $10 million asset, you don't do let's say you got a $10 million basis asset for 20. So you die, now the basis goes up to 20, but it's also 20 minus 11.7, the difference times 40% just went to Uncle Sam. Uncle Sam became your partner. So if we could do something today through discounting to magically not have an estate tax and save you that money, maybe that step up in basis isn't as magical as you thought it was. It's all a numbers game, and usually when we're working with people, we're presenting spreadsheets that show them what the magical benefit is or what it wouldn't be.
How available are you in the next 30 days? I mean, are you guys beating down your door because of this potential change?
Guys are not beating down my door because it's the same guys and gals who have refused to do anything. They just there's a group of people. First of all, they think they're gonna live forever, or they don't care. You know, they've worked hard. Maybe their children didn't. Or there's another group of people that are very philanthropic. 50% of their estate's going to go to charity. So I mean, knocks a lot off the top. Then there's another group of people who are really concerned, but they just can't wrap their head around what they need to do or the cost. You know, it's not free to get an appraisal on business. It's not free to have hire an attorney or hire an SBA to help you do this stuff. So mostly people are successful, are also frugal. I say penny wise, pound foolish, because if you're not doing the planning, and I talked to a couple the other day in Lodi, probably worth 15, 16 million. They've got four plus million sitting in life insurance. I said, I just saved you 1.6 million today. We're gonna set the island. Headline, 1.6, they just saved you. Because we do expect the lifetime exemption to go from 11.7 to 6.03. So that 4 in life insurance, we took off the plate, not now they don't have a taxable state anymore.
Or would you expect that to possibly go back to that 11.6 and say, you know, yeah, and then.
I would never would have expected it to go down. But for the fact that it was already a built-in sunset 26, because usually I look at taxes as a lot of Democrats look at in terms of benefit programs. If you give someone a benefit program, it's hard to take away. If you give someone a tax benefit, it's hard to take away. It's not impossible because Congress churns over and philosophy and political agendas turn over. So as Eric pointed out, we had 39.6 before, but we had it before, so we can see it again. We never had 11.7 million as a lifetime exemption before. Okay. So, but we've had 5, we've had 3, we've had 1, but it was always rising. So I didn't really fully expect it to sunset until 26. And then I was even thinking, well, maybe the Republicans would come back in and do away with the sunset. But it looks real that number is going to be reduced as of January 1. Especially with all the other doomsday stuff I was saying, with the loss and step up, with the taxability at that, with all these other things that we were talking about in the black cloud when, you know, when the election took place and Georgia turned Democratic, we were really talking this world could end just by estate taxes. Yeah. And so I always said at that point as well, I think some of that was a trial balloon, like to get people really scared so that when this stuff comes in, they won't think, oh, God, thank God it's only a drop in lifetime exemption. You know, that still means a lot.
Yeah.
So what you're saying is that $6 million level is gonna sunset in 2026?
Nope.
No,
11.7 was going to sunset in 2027.
11.7.
They're going to accelerate it, I believe, to 1 of 22.
Do they give like an end date?
All the tax changes in the bills that are out there now will be permanent, as permanent can be when we talk about taxes.
That's got a budget out eventually.
Yeah, they're only permanent until the next administration comes in.
Everyone's talking about that.
Yeah.
Well, maybe you could tell us a little bit about SBA, and obviously you guys are, you know, high-end financial advisors with a focus. With a focus.
Actually didn't bring one here.
If you want to get hold of Eric, take one of my cards. There's some brochures there.
That's why our marketing people print those out. If I bring them back to the office, they get all upset about it. So if you guys don't take them, I gotta throw them out here.
But very quickly, SBA is a full service accounting firm, tax, assurance, consulting, and we have a huge real estate practice, a big hospitality practice, so hotels and restaurants and whatnot, a big medical practice that stems all the way from doctors and dentists to veterinary practices, large to small, so.
Sounds good. Thank you.
Nice meeting you.
I have to be somewhere,
All right.
so. Yeah.